PFIC stands for Passive Foreign Investment Company, and just curious, perhaps by a show of hands, how many of you have actually heard of this term? Okay, quite a number, that's good. So the reason that we should perhaps get a basic understanding of these rules is that perhaps the best way to sort of think about how bad these rules are is to compare to what normally happens to a US shareholder. So say a US person buys shares in a Canadian company, holds it for 4 years, sells it at a gain, okay? Normally under US rules, capital gains are taxed at 0 to 20% depending on your income bracket. So the worst that can happen is that that US person pays tax at 20%. If, however, you're dealing with a PFIC, the whole situation changes in that that gain is deemed not to be earned in year 4 when you sell it, but it's allocated to every day that you held the stock from day 1. So what that means is that you have income not just in year 4, but in year 1, 2, 3, 4. And the income that's allocated to year 1, 2, and 3 gets taxed at the highest rate. And right now it's at 39.6%. And on top of that, there's a penalty interest of 4% per year. Okay? So going back to the example that I was just talking about, for the first year, you're looking at roughly 51%, right? 12% plus 39. So that's a pretty bad situation. And that's why, you know, when US people invest in Canadian companies, if they are sophisticated enough, they will ask, are you a PFIC? That's why they ask. Because when they sell the stock and when they have a gain, nobody wants to pay tax at that rate. Now the PFIC rules, they're very draconian because there's not an ownership threshold. So what I mean by that is, there's another set of rules called the CFC and Subpart F rules under the US law, and there's a threshold of 10%. So you have to have 10% of the company before you'll be subject to Subpart F. But for PFIC rules, you can own 2 shares, and you can be at 0.1%, but those rules will apply to you. The only time that the PFIC rule doesn't apply is what we call under a CFC PFIC overlap. So when you are a CFC shareholder, then the PFIC rules are trumped by the CFC rules, which is a good thing. So why do we have these PFIC rules? When you read all the commentary and the rules and the regulations and the IRS Treasury disclosures, I mean, the reason for the rules is that the Treasury thinks that US people are trying to hide their assets offshore. So when you buy shares in a non-US company that generates passive income, the presumption is you did that to avoid tax. So that's why they hit you with the highest rate, right? Because they're saying, look, you only did this to avoid US tax. So we're gonna take that income and we're gonna allocate it to day 1 and you're gonna pay tax on that from day 1. And they use language like, you know, the rules are intended to equalize and to level the playing field. And they basically create this tax fiction, like I said, by this allocation of not taxing you when you actually realize the gain, but they take that gain and they shove it back to day 1. So the next important question is, what is a PFIC? The definition of PFIC revolves around 2 tests, and it's an either test. So what I mean by that is that if a Canadian company passes one of the 2 tests, you're deemed to be a PFIC. You don't have to pass both. The first test is what we call an income test, and under that test, if you have more than 3/4 of your income from passive sources, dividends, interest, you know, royalties, and cap gains, then that company is deemed to be a PFIC. The other test is the asset test, and there's a 50% threshold. So if you have active income, but more than half of your assets are held to produce passive income, then you're still a PFIC. So it's an OR test. And one question that we get a lot is, okay, I'm a junior mining company, I have a lot of cash, but I keep that cash in my active trader business. I'm digging holes, I'm trying to find a profitable ore body, so shouldn't my cash be active because I hold that cash for the purpose of my active trader business? Unfortunately, the IRS has published guidelines that says cash is always passive. It doesn't matter that you held it for your active trader business, it's always passive. And one comment on the asset test is that we usually do it on the fair market value basis, and in fact, public companies have to do it on fair market value basis. Private companies have a choice. There's also a 25% look-through rule. So if you have a Canadian company that has a Canadian sub, then you actually include the asset and income of that sub. Because once you get over 25%, you have to look through it, which is reasonable, and determine your status based on the activities of your sub. So you could end up with two PFICs, the parent itself and the sub. That's why we call the tiered PFICs. So some of the common examples of PFICs would include, like I said, junior Canadian mining companies by virtue of the cash they have, or if they're not generating any sort of revenue but just have a lot of passive income, then they probably fail both tests, right? Canadian startups for the same reason. Companies that hold investments as their main source of income. And the last one tend to catch a lot of people by surprise, and that is Canadian mutual funds. So one question I had when I read through all those rules years ago was, well, hang on, Canadian mutual funds, most of them are trusts, right? And the definition of a PFIC by the virtue of letter C means it's a company. Well, trusts are not companies. So how can a Canadian mutual fund be a PFIC? Doesn't make any sense. But the IRS has, again, put out guidance that says, no. Canadian mutual funds, in fact, any non-US mutual funds are PFICs because they generate passive income, right? But, to us, they're a company. We don't care what you call it in your local jurisdiction, okay? For our purposes, for the purpose of PFIC rules, mutual funds are PFICs. So what can you do about PFICs? I mean, nobody wants to pay tax at those rates. So luckily, the Treasury has given you some choices. The first one is the QEF, Qualified Electing Fund. Some practitioners call it QEF, but I think no tax terms should sound like a duck, so I call it QEF. So under this election, what would happen is you treat the PFIC not as a company, but as a partnership. So what I mean by that is you treat it as a flow-through, and every year you would pick up your pro rata share of the company's earnings and gains, whether or not they're paid out to you or not. Okay, so we treat it as a partnership, not a corporation. And as a US shareholder, like I said, you pick up your pro rata share of the company's earnings and cap gain. So the problem that creates, obviously, is you haven't been paid the income, but you have to pay the tax, right? Because, that pro rata pickup happens regardless of whether there has been an actual distribution. But the benefit of this QEF and why a lot of people make this election is by doing so, you don't have to pay tax at the highest rate and you don't have to pay interest. So you're still ahead, relatively speaking. And with this QEF election, the income that you pick up luckily gets added to your basis, and that's always a good thing. And the ultimate gain that you realize upon the disposition of that stock still qualifies as a capital gain, and that's critically important to all the US taxpayers because your personal tax rate on capital gain, like I said, is from 0 to 20% versus ordinary income, which is at 39.6. So that's a huge rate spread. Another problem with the QEF that we've been dealing a lot with is in order for the US shareholder to make this election, they actually need to have this statement from the company that tells them this is your share of my earnings and this is your share of my capital gain. So you can pick that up on your US return. And the company, more likely than not, wouldn't be able to do that calculation because in order to do that calculation, you have to go through what we call a EMP calculation, an earnings and profits calculation under US tax law. And that number is not your T2 income, and that number is not your financial statement income. That number comes from a mock US return, then adjusted by a whole bunch of items. So there is generally a fairly high cost for doing that. And that's why for some of the smaller clients, with US shareholders, the US shareholders actually can't make the QEF election because the company is not willing or able to provide that statement. The bigger mutual fund houses like Royal Bank and Fidelity, they have actually been kicking out those statements for the past 4 or 5 years now. So, because they realize that PFIC is a big problem for a lot of their investors. So they have been doing those statements. And we have done a lot of those calculations and statements for some of our pubcos as well. So that's just something that you need as a US shareholder to make the election. The other option you have is the mark-to-market election. So instead of treating the corporation as a flow-through/partnership, to the extent that the stock is regularly traded, what you can do then is you just simply mark that stock to its year-end price. And you compare that to your basis, and if you have any deemed gain, you have to take that into income. And that income doesn't get taxed as a cap gain. It gets taxed as ordinary income. So again, keep in mind of that rate spread, right? And if you're unfortunate enough to have losses, those losses or deemed losses are only deductible against the gains that you have previously included in income. So they won't let you create a loss by virtue of the stock dropping and you haven't been picking up gain previously. And similar to the QEF election, any gain that you pick up as income gets added to your tax basis. But the relative disadvantage, again, of mark-to-market versus QEF is on the actual sale of the stock, that gain will not be treated as a capital gain. It will be treated as ordinary income. But still, that's better than being whacked at the top rate plus a penalty interest. So those are the two elections that is available to the U.S. shareholders of PFICs. In terms of U.S. tax compliance, PFICs transactions are to be reported on Form 8621, and you also use this form to make either the QEF or the mark-to-market election. And the IRS always provides information on sort of how much time is needed to prepare the form and how much time is needed to learn about the law and all that good stuff. So on this form, the IRS estimates that it would take you 20 hours and 34 minutes, not 20 hours and 35, not 20 hours and 40, 20 hours and 34 minutes for you to complete this form. So it's not a simple form. And the other curious thing about this is I'm sure many of you know, there tends to be a lot of penalties for IRS forms. You know, there's a 10-grand penalty for F-bar, there's a 10-grand penalty for 5471, there's a 10-grand penalty for 5472, the list goes on and on. Penalties galore. For this form, which is fairly important, there's no penalty. Zero. Do people want to like chip in as to why that might be? Pardon me?
The tax preparer gets
Good try. Well, I don't know what the answer is, but I'm guessing, think about it this way. If you make the election, the IRS collects less tax, right? Because you're not gonna get taxed at the highest rate, and you don't have to pay the penalty interest. So is the IRS gonna force you to make the election by slapping a penalty on this form? That's the reason I can think of. But IRS will tell you, no, it's not that, it's just that we're lenient. So that's more or less a 30,000 feet view on PFIC. And the reason I think it's important is beyond the fact that during the past year, there's been a lot of clients asking us about this particular issue. The thing is, 4 or 5 years ago, you know, there's really no such thing as a PFIC audit because, you know, the rules been there for a long time, but for whatever reason, it wasn't high on the IRS radar. But now, you know, they revamped the forms, they updated the regs, they have new rules, and frankly, for them, this is just easy money. It's just a lot of tax revenue that, you know, that they can collect. So if you take away any sort of message from this 15-minute discussion is that if you're dealing with a PFIC, don't just let it sit there. Make an election, be a QEF or mark-to-market, because paying tax at 51%, that's nowhere to go.